Good morning. Today I would like to show some data that I'm following to decide whether we are closer to the bottom of the real estate market and it is time to buy again. Clearly, the elevated level of interest rates is putting pressure on property prices, with REITs having reacted fast. Admittedly, it is difficult to decide to invest in real estate when yields are at 5% and the 1 year deposit might generate the same return. However, we need to think long term, and high deposit rates might not last. At the same time, property income will continue to rise because of the pressure that inflation brings to rents. So it makes sense to monitor price action to establish whether it is a good time to increase our position. Now, this slide has been provided by Green Street Advisors, and it compares the total return of US and public and private real estate going back to 1997. For the private real estate, they are using both the NCREIF index, which is based on comparable transactions, and their own CPPI, Commercial Property Price Index, which is based on discounted cash flows. Notice how the CPPI index tracks much more closely the REIT index, but these are not transactions. These are just theoretical prices of where a theoretical buy would buy a private real estate. Now, the message we get from this chart is that listed real estate is cheaper than private real estate. That is not to say that listed real estate cannot fall further. We are reaching a breaking point in the interest rate cycle, and if liquidity dries up in the equity market, all listed assets, including REITs, might fall quite substantially. What this chart tells us is that if we decide to deploy capital in US real estate, we are better off doing it via the listed route for the time being. Now, the next slide may help us decide whether it is a good time to invest in real estate right now. The chart compares investment grade and high yield bond rates with the expected return of commercial real estate based on discounted cash flows. The comparison with high yield bonds is less reliable because these are much more volatile. At the moment, it would appear that high yield bonds have a higher expected return than real estate, but the number does not factor the potential of defaults. If we have a 4-5% defaults during a recession, high yield bonds might deliver less than real estate at this point in time. So bottom line, the premium offered by commercial real estate at this point in time is not sufficiently attractive relative to investment grade bonds. Either bond yields have to fall or expected real estate returns have to increase, possibly through an expansion of cap rates, leading to a further fall of property prices. On this next slide, I repeat the same comparison using the performance of our investment in a Timberland logistic warehouse in the Netherlands with a Tritax Eurobox, a logistic REIT. As you can see, both investments were fairly correlated until December 2021, but then diverged with the REIT reacting very fast to the changing liquidity conditions in the equity market. Lately, we have seen a downward adjustment of the value of our property, which has continued all the way to the 31st of March. Just received the information. However, it seems that we are nearing the bottom of the cycle, and possibly by the end of the second quarter, we should see a stabilization of the returns. Similarly, on the next slide, I'm comparing our investment in a Tesco supermarket in the UK with a supermarket income REIT. As you can see, up to the middle of 2022, the two investments performed very much in line. but then the REIT started to lose value as the stock market was faster in repricing higher interest rates. We have also started to see the value of our supermarket coming down at the December mark, with a small decline in March. But the Bloomberg data is not yet updated as we just got the valuations. Now, the situation has not gone unnoticed by real estate investors. As you can see from this slide, today Blackstone announced a £500 million takeover of Industrial REIT, causing the share price to jump 37%. So as you can see, private equity investors prefer to buy listed real estate, in this case taking private an entire REIT, as opposed to buy the underlying properties. So in conclusion, both in the USA, UK and continental Europe, the message is consistent. Listed real estate is cheaper than private real estate. As we are nearing the end of the hiking cycle, it makes sense to gradually build positions in REITs, bearing in mind that we are nearing the point of maximum pain for the economy, when something might crack. If that happens, listed REITs will fall further, at which point we should probably go all in, because central banks will move very fast to reverse the direction of the monetary policy and inject liquidity in the system. Thank you very much for watching this update. Feel free to reach out if you wish to discuss further.